Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sumera Abdi, and Pavitra Parekh is back from her fantastic holiday. How was it?
It was lovely, and it's good to be back, but it seems like there's been a lot going on here as well. We saw a big dip come through, but things are looking back up again now.
Indeed, looking up. So right now as we speak, the benchmark indices are up close to about 3/4 of a percentage point. The mid-cap outperformance extended itself. The mid-cap index is up 1.3% for the week so far. It's seen a rally of close to about 2.6%. A lot of business updates have been coming through, which gives you a sneak preview into what's likely to come out. From the banking side, the numbers are looking very good, whether it was M&M Financial or today AU Small Finance Bank. So banks have been outperforming. The Nifty banking index is up 2% for this week. But on the flip side, after Marico's miss that came through on Tuesday, even Godrej Consumer is talking about a hit on its EBITDA on account of inflation. So GCPL is a big drag today. And the Nifty Fmcg index for this week is actually down close to about 0.2%, which compares with a rally of 1.5% on the benchmark indices. So the Nifty Fmcg index has been a bit of a drag. It's been a big outperformer. There was a lot of money flowing into Fmcg, but that seems to have paused after the subdued business updates coming through from Marico first and then GCPL. All that and more lined up in the next 1 hour. But what about stocks?
In terms of stocks, it's really the metals pack which is shining today, right? So some of the bigger names will be up on your screen. So take a look at that. In fact, the Nifty metal index in itself is up around 2.6%. These are some of the big gainers. In addition to metal, some of the real estate stocks are doing very well. So something like a DLF, you have India Bulls Real Estate, Sobha. I'm just naming a few of them, but pretty much that entire space is buzzing around. By the way, IT is also holding up quite well today. So, I mean, of course, this is after the big kind of underperformance that we've seen. But today, those stocks are holding up. All of the IT earnings start next week. So this space will be very important to track. In terms of cues, of course, the earnings season is next week. We're watching what's going on with the crude prices very closely, and the US non-farm payroll data, which we track, also is due to tomorrow. So we have a lot to track, Sumera, today as well as tomorrow.
Hi ladies, morning. So let's get started with all that we have lined up on the show today. The Nifty and Sensex edge higher after a strong start despite a mixed global handover. Mid-caps are shining in trade. Metals, realty and IT charge ahead while FMCG slips. We'll talk about the outlook for the markets with Nilesh Shetty of Quantum Advisors.
Also in focus, the tech talent exodus. We will be joined by Sunil C of Team Lease Digital to discuss the company's latest report, Brain Drain, tackling the great talent exodus.
North America Class 8 trucks orders hit a record high of over 56,000 units. We'll be joined by the management of Ramkrishna Forgings to talk about what this means and the larger trends.
And Godrej Consumer Products and Persistent Systems are both buzzing around on the back of some news flow. So we'll get you all of the details on that in just a bit. So all of this and lots more coming up for you over the next 60 minutes.
Okay, but let's straight away get to the first guest on our show. One of the leading tech staffing firms, Team Lease Digital, has launched a new report, the Talent Exodus Report, which pertains to the IT industry. The report is titled Brain Drain, Tackling the Great Talent Exodus, is a comprehensive guide to increasing retention rates in the tech sector. We are now joined by, one of the authors of this report, Mr. Sunil C, the CEO of Team Lease Digital, on the show. Sunil, thank you very much for joining in. High attrition in the technology sector has been a burning issue for the last 1 to 2 years. Can we start this discussion by understanding what are the key highlights that you gather from the research?
Good morning. So based on the survey, we had a sample size of close to 700 employers and more than 6,000 employees across the tech sector. And we came across quite startling revelations when it comes to the attrition. Most of the time we feel that, it's the compensation which leads to the employees moving from one job to other job, while a better compensation and benefits definitely helps. And the employees take that and they try to, take the better salary and stay put, but it's a short-term fix. What we have seen is that a desire for flexibility, career growth, and employee value proposition. These are the three topmost things which we came across in the survey, which can actually retain the talent.
Sunil, good morning and thanks a lot for joining us. This is Pavitra. I'm going to come to the reasons that you mentioned of why talent is leaving and what really they're looking for, because that'll be interesting to talk about. But first up, just on this attrition, do you think that you're seeing any kind of plateauing, or what is the trend suggesting? Are we going to continue to see these kinds of levels?
See, short term, the recent quarter, we have seen the attrition slightly slowing down because what's going across in the IT sector because of the Western markets and geopolitical situation. But on a long term, we definitely feel that the attrition is going to be at around 25%. And there are various reasons for this attrition. It's just not the IT sector, which employs tech talent today. While over the last many years, IT sector has continuously grown, and today IT sector employs over 5 million, and it contributes to 8% of the GDP, whereas it only employs 0.8% of the workforce. But what you are seeing is that post pandemic, the digitization of super cycle has actually kicked in, and every organization has embarked on digitization, which meant that there is a huge tech requirement across the sectors. So considering that, there will be tech talent hiring happening across the industry. As per our reports, we are anticipating over 1 million tech talent requirement in the non-IT sector alone. So overall, we see that IT sector will double its employment over the next 5 years, and non-tech sector will hire over 1 million. So we are in total expecting around 6 million employees to be hired, or tech talent to be hired. On top of it, you also have the grappling attrition issue. So considering these scenarios, it's a very, very hectic and happening place in the next few years in the IT sector. So attrition, definitely, to answer to your question, attrition will happen because the startup ecosystem, the non-tech hiring, on top of it, there is a huge GCC movement which is happening to India because of the availability of better talent in this country. So, IT services companies become a coaching ground for all these sectors. So, there is always a demand and supply gap, as we always had a huge demand, whereas the supply was less. On top of it, with the huge opening up of the sector.
Okay, got it, Sunil. But, for this US, now the wait list for the visa just to get an appointment has extended to 2 years. So don't you think that might sort of dampen this whole attrition thing? Because after all, domestically, there are only so many attractive jobs available. And also, during your research, what evidence have you found in terms of how prolific moonlighting now is within the sector? Is that also one of the reasons why people are quitting?
See, moonlighting has always been a prevalent practice across the tech sector. While there is an ethical moonlighting or non-ethical moonlighting, I would say, because wherever when you pick up a permanent job, you should be very clear that you can't have a diet coke approach where you don't want calories, but you want taste. You have to decide whether you want the regular salary plus all your benefits, or you want to experiment with or pick up other jobs. If there are different kinds of contracts available in the market, you have contracting, you have consulting, you have gig. So if anybody is looking for moonlighting, our advice is to pick up alternate employment opportunities rather than picking up permanent employment. And now, since this moonlighting has come to forelight, so a lot of restrictions have been imposed, and which can also lead to some kind of attrition, because as such, post-pandemic, there is a awakening in the employees. They feel that do they need to work 9 to 5 and be linked with only one organization, or should they experiment with their careers? That's something which also came through in our survey, that people have started thinking beyond their regular jobs. So all these can definitely lead to increased attrition.
Okay. Sunil, you highlighted three factors which can help companies retain their top talent. One of them is flexibility. The other one is career advancement opportunities, a roadmap for growing in the company. And third is, I think, feeling valued. The employees should feel that they're important, right? These are the three factors which can help in retaining talent. Is there a cost element for companies as they try and implement this? My question is just to understand that, do you think that as companies try and incorporate these reasons, will it hurt their margins?
In the short term, it might hurt, but in the long term, it may not, because the cost of rehiring a candidate is much higher than what investments you would make to retain the existing talent. Quite often we underestimate the power of our existing employees. We always feel that buying a talent at a premium is much better, and when you have attrition, you end up paying much higher. So if you have a long-term strategy, our survey says that as a long-term strategy, if you have a regular upskilling opportunity and you have a better employee value proposition where you can ensure that your employees have been upskilled, trained, and you provide better opportunities to them in terms of overall well-being of the employee, I'm sure you can control to a large extent the attrition.
All right, that makes sense. Perhaps in the short term, this could be an added cost. But if you are able to sort of avert a significant part of the attrition, then perhaps, it balances itself out and it will not be that much of a cost to the company. So, Neil, thanks a lot for joining us today and taking us through the highlights of this very interesting report. With that, we're going to get into our first short break on the show. But up next, we're going to shift focus and talk about the commodities space. Manisha Gupta will be with us.
Hi, welcome back here with Trading Hour. Over to Manisha now, who joins in to tell us all that's happening in the commodities space. And today, the focus is on metals. Hi, Manisha. Morning.
Morning, Sumaira. Well, yes, it's a second straight day when we are looking at good gains continuing in case of the metal prices. Yesterday, it was all up between 1 to 4% and 1 to 3% of a gain is what we are seeing for a second straight day as well. The best of gains clearly coming in from zinc, where we saw 4% up yesterday. It's trading 2% on the higher side right now as well. Copper was up nearly 3% overnight. It's trading more than a percentage point higher. So actually, aluminum, nickel, all of that is trading in the positive in the markets right now, even as the Chinese are out of participation. Well, this is because LME is restricting new deliveries from Russia's Ural Mining and Metallurgical Company. And the first one to go down clearly in sense of zinc. And we will be looking at no trading or deliveries on exchange on LME for the metals from this company is what really seems to be bothering the international markets there. The companies can only deliver if they can prove that there is no breach of sanctions. So until that is proven, and that may take time, days or weeks, until then no new material can come on LME exchanges is what is keeping the prices on the higher side. For zinc especially, it is also about Glencore, which has placed a Nordenham zinc smelter on maintenance from 1st of November, citing higher energy prices. That's keeping the prices higher too. In any case, 50% of Europe capacity in sense of aluminum and zinc has been shut in past year. And the markets do believe that with the gas prices keeping higher and weaker demand from Europe, you could be looking at more smelters and more mining companies actually going in for maintenance there. That is the week-on-week prices on your screen right now, where we have seen aluminum and silver prices gain up by nearly 11%. It's an 8% gain in zinc in this week itself, and nickel and copper up between 5 to 6% as well. Markets do believe that since the US dollar is on the weaker side, just about holding 111, there is still some buying that you can see in metals for the rest of this week.
All right, Manisha, thanks a lot for getting us all of that action from the metal space. In fact, it is this entire sector of stocks also which is lending support to our markets today, with JSW Steel, that is the top gainer on the Nifty right now, around 4% higher as we speak, and the market also around the high point of the day. So let's get into a quick break now, but when we come back, we'll talk about the market technicals. Himanshu Gupta of Globe Capital will be with us. Hey Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. The market is holding up well. It's an over 100-point gain that we're seeing on the Nifty, but the real action is in the mid-cap space today. It's up around 1.3% as we speak. So let's talk about one stock from the mid-cap space that's really buzzing around. It's up 6%. That's Persistent Systems. This after JP Morgan upgraded the stock. So Nimesh is here with today's standout brokerage report. Hi, Nimesh.
Hi, so as you rightly pointed out, the stock is reacting sharply to the JP Morgan upgrade. It is up 6%. And JP Morgan today has upgraded the stock to overweight from neutral. They have raised the target price to 4100. In fact, Persistent is the only stock in the ER&D space for JP Morgan which has got an overweight stance now. 4 reasons why they've upgraded the stock. First, they believe that Persistent has a relatively defensive portfolio with exposures to sectors like software tech, BFSI and medical clients, which are relatively more resilient. That's the first one. Second, Persistent has the highest exposure to the US-based clients who are relatively better placed on tech spends compared to the European clients. That's the second reason for the upgrade. Third, Persistent derives the highest share of revenues in dollar terms, and dollar has been strengthening versus the INR, so the numbers are expected to be strong. And fourth, they expect the highest CAGR of 25% for Persistent over the next 3 years. In fact, even in terms of valuations, it's relatively undervalued compared to the peers like L&T Technologies and L&T Infotech, and at par with other peers like Mindtree. At 26 times funny of forward earnings, JP Morgan believes that the valuations are quite attractive to entry at these levels, and hence a big upgrade. So back on that JP Morgan upgrade, the stock is up 6% and has been one of the top gainers in F&O today.
Thank you very much for that. From IT to FMCG, Godrej Consumer slides after reporting its Q2 business update. Mangalam gets us up to speed with all the details. Mangalam.
Well, that's correct. So Godrej Consumer is losing in trade, understandably, because of its second quarter update that the company has reported. And a few things really stand out from a company standpoint. In the quarter itself, the company at a consolidated level has reported a mid-single-digit sales growth. And that would mean around a little higher than mid-single-digit sales growth. That would mean around 6 to 7 odd %. But that accounts for not much as far as the profitability is concerned, because they are saying that the EBITDA may actually decline by almost, mid-teens, close to around 14 to 15% is what the street is penciling in this time, and this is on account of 2 factors. One, high cost inventory that the company was sitting on, and secondly, upfront marketing investments that they've been making. As far as the India business is concerned, they're likely to see a high single-digit growth, but then again, that won't be volume backed because of higher raw material prices. They had increased the prices in soaps, and that has had an impact on their volumes, because the India volumes would actually decline in mid-single digits as well. Indonesia has been a bit of a problem for the company for the last many quarters, and that may continue this time around as well. Early double-digit constant currency sales decline. The only bright spot for them is the Africa as well as the Latin American business. For Africa, they are expecting to see almost low teens sort of growth this time around. That would mean the 9th quarter of double-digit growth. However, from an industry standpoint, 3 things stand out. The company says that the industry remains soft in the second quarter. Secondly, rural market witnessed slower growth compared to urban. And finally, they expect consumption to improve in the second half of this year. From the first quarter itself, everyone was talking about how there would be recovery in the second half, but they had to contend with the second quarter, and the second quarter, understandably, not looking too good. So to that extent, today's low on the stock will be crucial to watch.
Mangalam, thanks very much for joining in with those details. Let's invite Himanshu Gupta of Globe Capital now for a quick tech check on the market. Hi, Himanshu. Morning. Thanks very much for joining in. So it looks like another day of heading higher. Where do things look to move from here, and what's your index strategy?
Good morning to you, Sumaira. Well, I think the charts, the setup, and the derivative data all are positioned in sync, and all are pointing towards a higher move on both the indices as far as Nifty and Nifty Bank are concerned. On the Nifty, I think the data placement is relatively better, where we have been seeing since morning in today's expiry 17,300, 17,350, and 17,400. All these strikes have been increasing significant amount of OI addition as far as the put writers are concerned. So I think we might see a recovery, and in the second half of this session in today's trade, we can expect a move towards 17,500 in Nifty. So a dip towards 17,300, 17,350 is a good buying opportunity as far as Nifty is concerned. Would place a stop loss below 17,275 and eye for a target of 17,500 as we close today's weekly expiry. Nifty Bank also the data is equally good, but here some kind of call writing is also visible on the higher strike around 39,700, 39,800. So I think a dip towards 39,200 odd level offers a good entry level as far as Nifty Bank is concerned, with a stop loss below 39,000 and a targets of 39,650 and 39,900 can be seen in Nifty Bank also. If you have to take a comparison, I think Nifty is placed better as far as today's positioning is concerned. Talking about individual stock ideas, I'm going with a couple of buy recommendations. The first one is a buy on Idfc Limited. Very strong breakout from a very long-term downward sloping trend line, and I think this IDFC and IDFC First Bank both are heading higher. Idfc Limited can be initiated along around current levels, keeping a stop below 69.5, and the targets close to 75 can be expected in the very short term. Second one is a buy on Z Entertainment. Again, the stock has given a very strong breakout in today's session, and I think we are likely to see some follow-up buying here. So Z can be buy for a target price of 300 in the near term and a stop loss below 277 can be placed. And finally, a stock from the cash segment, that's Praj Industries. That stock is on the verge of giving a very strong breakout on the long-term charts. So Praj can be bought here for a target price of 450 and a stop loss below 425 can be placed here.
All right, Himanshu, thanks very much for your trades this morning. A quick break. Up next, we'll talk about the market fundamentals. Joining in will be Nilesh Shetty of Quantum Advisors. Stay tuned.
Welcome back. Some of the rally has fizzled out. The Nifty's lost about 75 points from the top of the trading session, still holding up firmly in the green, up about 0.5%, but some of the gains have been shaved off in the last 10 minutes. Profit booking is coming through on IT names. So Infosys is under pressure. Tech Mahindra is losing some ground. Fmcg names are also weak in trade. So Asian Paints is now dipped into the red. Sharp slide in the last 10-15 minutes of trade. HUL has been struggling since morning and it's now down close to about 1.5%. Let's find out the outlook for the markets. Nilesh Shetty of Quantum Advisors now joins in to discuss the way forward. Nilesh, morning, and thanks so much for joining in. What's the sense that you're getting about the rural markets? Because on one hand, the business updates from Marico, GCPL seem to paint a picture that the rural markets are under stress. But on the other hand, NBFCs or banks which cater to the rural segment, like an M&M Financial's business update was very strong in terms of disbursements, advances. So that's telling us that there is money over there. So can you tell us what is it that you've gauged on the rural market side and what are the implications as we enter the earnings season?
Yeah, at least whatever companies that we have spoken to, sort of very positive of what is happening in rural India, including some of the names that you mentioned. Tractor sales, especially after wheat prices went up, were very robust and actually surprised on the upside, despite the assumption that it was going to be a weak year for tractor sales. And most of the companies that we speak to, given that it's been an above normal monsoon, by and large, farm prices are much higher this year. The assumption is that it will be a very good year for rural sales for most companies. So at least our view remains that it will be a good year. We are very surprised on some of the branded names and the company that has recently come through. But it could be a function of down trading in an inflationary environment, not necessarily sales overall getting impacted.
Okay, Nilesh, good morning and thanks for joining us. This is Pavitra. The other space I want to ask you about is the IT sector. Of course, the earnings start next week. We've seen the kind of cuts that have come through this year. It's been a near 30% fall on the index itself. Do you think there's a lot more pain left in this space?
The companies that we speak to on the ground suggest so far there has been no cutback from any of the clients on IT spends. I know the market has been very, very worried about US recession and the impact for the sector. But none of the companies on the ground have suggested there has been any client pullback on any projects or any cut in the spends as of now. But I assume at some point it will start creeping into the numbers. That is already in the valuations. And you look across most IT companies, they are down from in the region of 30 to 50% if you go deeper down in the mid-cap IT space. So our sense is a lot of the negativity is already in the price and things may not be as bad as what the market believes it to be. So for us, it's actually been an entry point or to add more into the names that we already have, given the correction that has happened over the last 6 months.
Okay. Hi, Nilesh. Morning. As we sort of head into the festive season, or rather we're already in the midst of it, what are the kind of stocks or sectors that you would keep your eye on as, we have this end of the year, and etc. What is looking favorable right now?
So we have a very large overweight on the two-wheeler space. I mean, even today, two-wheeler volumes are less than what they were doing a decade ago. There are many reasons for that, including sort of cost push and a lot of the sort of end consumer demand drivers, including say IT companies, are still in a hybrid mode. But our sense is if there is some sort of uptick in the festive season, given where valuations are in that sector, I expect them to be re-rated very quickly. At least that is where we think. By and large, again, the festive season is expected to be very robust this year for most companies, given that last by different waves of COVID. So at least we think broadly most sectors will do well. And within that, at least we have a large weight in the two-wheeler space, given that there is a big scope for volumes to get related.
But two-wheelers like Bajaj Auto and TVS Motors, exports have been under pressure, right? I think for the month gone by, Bajaj Auto's exports were down 33%. TVS Motors export sales declined by 9.2%. Isn't that an overhang? And which would be the two-wheelers then you would bet on?
Yeah, for specific names, yeah, because exports have actually been very, very robust for them. On that high base, you might have some seasonal volatility. But the domestic numbers still remain weak across for most companies. They are far below their peak volumes. So once the domestic volumes pick up, I expect all the companies to get re-rated actually.
Okay, Nilesh, overall tell us, if someone wants to put in fresh money into this market, what are the sectors, the spaces where you think that, there's a better chance of outperformance? Financials have been a favorite for a while. So do you think that space still stands out?
Broadly, post the COVID rally, two sectors have materially underperformed. One is the consumer discretionary space, primarily sort of the automotive and the two-wheeler space, and the second is the financial space, and a lot of it private sector banks, which have underperformed the rally. And we expect at some point, given that credit growth is picking up and consumer demand is coming back, both of these sectors will start doing well. So at least for us, we have large overweights in both these buckets as of now.
Is there a risk of downgrades in the FMCG sector? As we started off the discussion, the earnings update from Marico and GCPL were fairly subdued. Is there a risk of any sort of downgrades? Is that something that the street is talking about or investors are concerned about?
Yeah, for us, I mean, we are value investors, though. The portfolio is run in the value side. Unfortunately, most of the consumer staple names have always been very, very expensive. And if you look at sort of India's history, so from 2015 to 2020, in a very low growth GDP environment, even though these companies were growing at a slower rate than their history, these companies got re-rated quite dramatically in price to earnings multiple. Given the expectations that are built in terms of valuations, I think they may disappoint on the actual delivery because other sectors have caught up in terms of growth. So investors will start asking questions, given the growth advantage is not that great being parked in this sector, what is the reason they're trading at 50, 60 times earnings? So you might see some reallocation from the end investors. That may happen. But again, it's a fantastic long-term story. Investors who want to stay allocated for the next 10, 20 years, they have a very simple consumer story to get allocated to, and they may continue to prefer allocating to consumer staples.
Nilesh, just one last question that I'll ask you is on the real estate space. I mean, we've been talking about the solid demand. We've seen prices go up in this space. And this is normally sort of a cycle that, spans a longer time period. So do you think it's a good place to go stock picking?
Yeah, surprisingly, despite the interest rate hikes, when we looked at data in September as well, there has been no slowdown on the real estate side. They continue to remain very, very strong. And our sense is you will have transactions picking up over the next 3-4 years or remaining strong. I don't know how much pricing will go up because most of the developers tried to focus on the luxury segment, which did not do that well. So they are now focusing on the affordable and sort of the mid-market segment. So you will have a pickup in transactions, not so much maybe a pickup in pricing, but we expect real estate cycle to last for the next 4-5 years, which again is a primary driver for economic activity. The question is, can you play that through the listed entities? So there are 1 or 2 quality names which trade at significant premiums. But once you go below them, there is a big question on corporate governance in some of these names. So real estate has been one of those great macro stories for India. But if you try to buy companies to play that theme, it's not worked out well for investors. At least we've never had any allocation to the real estate space in the portfolio.
Do you like any of the REITs, Nilesh?
No, we are pure sort of equity investors. We don't have REITs in our portfolio.
All right, got that. Nilesh, thanks a lot for joining us and taking us through your call on all of these individual sectors that we asked you about. With that, we're going to get into a short break on the show now. But before we do that, here's some great news for investors. You can now track US market action real time on Money Control. So log on to the Money Control website or app and stay informed about all that matters in global markets.
Hi, welcome back to Trading Hour, and let's turn our attention now to the auto sector. North America Class 8 truck orders have hit a record high in September. Sonia is here to tell us give us more details on this. Sonia.
Well, you know, that's the big headline. There has been a significant improvement in the North American market as far as the Class 8 truck orders are concerned. A record high this time around. Whichever way you slice the data, it is looking pretty robust. On a year-on-year basis, it's a growth of 102%, and on a month-on-month basis, the Class 8 truck orders have gone up 164%. Now, Class 8 market in North America is segmented into trucks and tractors with and without sleeper cabs. So from the Indian market perspective, which are the companies that have an exposure there? Bharat Forge is up almost 9% as the company gets 22% of its standalone revenues from the North American Class 8 truck market, to which it supplies forgings. Ramkrishna Forgings as well gets 23% revenues from the North American truck market. GNA Axles is another company that gets about 30 to 35% revenues from the US Class 8 trucks. And Samvardhan Motherson or SAMIL gets about 7 to 8% exposure to the Class 8 truck market in North America. Now, many of these stocks have rallied, as I mentioned. In fact, Bharat Forge is now less than 10% away from its 52-week high. ACT Research, which is the company that puts out this data, said that OEMs have fully opened their order boards for 2023 a bit earlier than normal. And the September Class 8 orders were sensational no matter how you slice the data. Over the past 12 months, almost 250,000 Class 8 orders have been booked. So big positive coming in for that market. Back to you.
All right, Sonia, thanks a lot for getting us all of the details on the North America Class 8 orders. Let's also talk about some auto ancillary companies like Ramkrishna Forgings, which have a big exposure to the North American market. In fact, Ramkrishna Forgings gets around 20% of its revenues from the North America market. So let's talk about how things are really shaping up. Lalit Khaitan, Executive Director and CFO of Ramkrishna Forgings, joins us on the show now. Mr. Khaitan, good morning and thanks a lot for joining us. This is Pavitra. Now, I know that while we've spoken before, you have said that the Class 8 truck orders don't really impact you, but overall it just seems like demand is looking strong, whether it's in the North American market, even in our own market. That is the theme we have been discussing. So do you think this kind of trend can continue, or do you think a lot of this is still pent-up demand and perhaps we could see some moderation from here?
No, this kind of trend will continue. Yeah, this may look like to be pent-up demand, but certainly it's not going to moderate much. And I will say a robust demand will continue for Class 8, though there was a healthy order book already pending, a healthy order book, and this kind of demand will certainly boost further to the order book, and it signals the easing of supply chain issue basically, because this kind of acceptance of orders on behalf of manufacturer signals that, and that's a good news for the trucking industry.
Sir, in Q1, I think the order wins were about 388 crore. What's the number for Q2 and what's the outlook on order wins?
I don't have the exact number right now, but I think it's total up to Q2 is around 500 crore, and it's a process that's continued, and we hope to win similar kind of orders in near future also.
So approximately Q2 order wins should be 500 crore plus or minus, which compares with 388 crore in Q1?
No, I am talking about H1 total.
H1.
500.
So doesn't that then imply that there has been a decline in order wins in Q2 versus Q1?
See, these are the new orders for the new product and for the new customers. We never announce the regular orders, what we win. So it's it depends upon the approvals from the customers. So it's a process and it goes on.
Okay, so in terms of new orders, like to like, how would it be? Because, there are a lot of worries of slowdown in US and particularly Europe, and you have a 13% revenue exposure to Europe as well. So could you give us a like-to-like comparison in terms of renewal of orders as well as new order wins?
See, overall, if you look at the composite, we are doing much better than what we were doing earlier. And if you compare last year, it's much better. And we have earlier also said we are going to grow around 15 to 20% in exports, and we maintain that target. Combining Europe and US, we are going in both continents.
Okay, you maintain your 15 to 20% growth target. That's good to hear. Mr. Khaitan, let's also talk about the domestic market because that is looking very strong. You saw almost 80% growth last quarter. Can you tell us what is the kind of demand that you're seeing in just the domestic market now?
Domestic market also remained quite robust, and we see a good demand, and demand are little bit increasing month on month. I will say it will be better than what we have seen in the earlier H1.
Okay, and sir, like you mentioned that you will see 15 to 20% growth, but one place where we did see some contraction was, of course, the margins were, of course, like the rest of the industry, you did see some contraction because of the raw material prices. But with those having cooled, do you think that that can pick up once again? And what would be the margin guidance for the coming quarters?
See, there are a lot of challenges on margins. Certainly, raw material prices in our case has not gone down, but there are other cost pressures, but there are savings also in terms of freight cost. So freight cost has gone down substantially. So overall, we need to balance and we have to improve upon the other costs to maintain the margin. And we are on track to whatever margins we have achieved so far, we will be continuing to achieve that kind of margin, or we may improve upon that.
22 to 23%, right, is where your margins have been, and that is what you're looking to maintain?
So last quarter we posted around 22%, and we will be certainly posting that kind of margin, or maybe we will try to improve on that.
Okay, so you're looking to maintain margins at Q1 level, and the aspiration is to improve it. So you also recently concluded a fundraise, I think about 94 crore via warrants. But in the Q1 conference call, I was listening to it, and you did say that you have dropped your fundraise plans because of where the stock price is, and then you decided to go for a warrant issue, which is only going to help the company raise about 94 crore, and that is also once it's fully concluded. Upfront amount is going to be a lot lesser. Could you tell us, is this sufficient in terms of fundraise? What were your earlier plans? How much would you have liked to raise? How much does the business need?
Oh, we have already, you have correctly said, we have dropped our fundraise plan. This was a small fundraise only to have the promoters to increase their holding. A promoter would like to have their holding increasing to 50% plus. And that's why this is a directional fundraising, and this kind of promoters fundraise, stake raise can continue by way of preferential issue. So right now, this was a small step on this direction to have a 50% promoter holding.
Okay, that is on the fundraise. Just one final question. After your Q1, in the Q1 presentation, you also mentioned that you're on the verge of entering the railway business. Can you tell us what's happening on that front? Has there been any progress?
Yeah, railway business is looking up. There are a lot of orders and traction we are seeing from the railway, and it's improving. And we can see a significant growth in the railway business in the upcoming quarters.
All right, Mr. Khaitan, thank you very much for joining us. We'll leave it at that today. Thank you for joining us and taking us through your outlook. Demand looks up. The company says that they are looking to grow at 15 to 20%, and they will try to maintain margins at Q1 levels and perhaps even improve on those levels. With that, we're going to get into a short break now, but there's lots more on the market action when we come back.
Welcome back. Steady right now, so we're up about 0.5% on the benchmark indices. We've lost a bit of ground from the top of the trading session, but in the last 15 minutes, things have been quiet. Happiest Minds is a stock you should also look at. It's up 2% today. The stock price has crossed the 1,000 rupee mark. This is after the board approved a fundraise of nearly 1,400 crore rupees over the weekend. This is over and above the 600 crore of cash that the company has. So it'd be interesting to find out what they plan to do with this, incremental 1,400 crore of fundraise. They do have aggressive growth plans. They want the company to be a $1 billion company in terms of revenues in the next 10 years. So perhaps there we could expect some M&A many out of Happiest Minds. Another stock that we've been looking at over the last few days is Max Ventures. And look at the way the stock is rallying on very, very large volumes. This is the last, 1 month chart, and the big spurt has only come through in the last 3 days. Last week, we had a chat with the management of Max Ventures, and at that time, they told us that the current residential real estate portfolio in the NCR region is about 2 million square feet, but they have development plans of up to 8 million square feet, 7 to 8, which means a 4x jump, and they're also in plans to further increase it to 10 million. So they've got some aggressive plans, and the street is latched on to that. But we're out of time on, trading hour. But as we wrap up this show, we leave you with some important market opinion that we got from Gautam Trivedi of Nepean Capital.
I think downside is certainly left in this market. I tell you where I'm coming from. Again, in spite of all the stuff that we've seen, and of course, you've seen some degree of FIs coming back into the market, which was a positive briefly. Again, last month they sold almost $1 billion. So will India end up decoupling? I don't think so. What we see is the other concern, of course, is in terms of valuation. And again, I've said this before, India has, of course, always been one of the most expensive markets among the emerging markets and always the most expensive Asian market. But now we're at 20.3 times calendar 23 PE, which is more than double that of China's. MSCI China is now at 9.3 times. We could certainly revisit that. I don't know about going below that, but certainly revisit that. And the reason I say that is because we've tested that once already. Now, let's keep a couple of other factors in mind. That, yes, the recession and the issues that are there in the West are not necessarily the same issues that we have back home in India. So let's get practical about that. The ability to support this market when that fall does come, and I hope it doesn't come, but assuming it does come, will be, I think, driven by how much more attractive other alternative investments are.